Welcome, dear traders. Today, the most anticipated event of the week, the FOMC meeting, is on tap. The Fed is going to announce its key rate decision in a few hours. Stock markets drifted lower yesterday ahead of the meeting. Asian stocks are also declining today due to mounting fears of a global recession. Learn more details in our video review, and let's start. Currently, nobody doubts a rate hike at today's meeting. The regulator is highly likely to raise the interest rate by 75 basis points. The CMI FedWatch Tool suggests a 16% chance of a 100 basis point rate increase. And yesterday the figure was the same. The prospect of an aggressive rate increase is fueling pessimism in the markets. The Fed has stated many times that its top priority is to tame soaring inflation, even if monetary tightening triggers a slowdown in economic expansion. Now, it's the blackout period, so Fed policymakers do not make any comments about fresh macro stats apart from a rate decision the regulator is going to reveal in new economic projections and the dot plot. These stats and the speech of a Fed Chairman Jerome Powell after the meeting will provide investors with the hints about the further steps on the monetary policy. As the Fed aims to return inflation to its 2% target, speculators are going to look for remarks about the end of the monetary policy tightening cycle, the prospects of the labor market, inflation, and economic growth. The US dollar enjoys luster with the investors amid the Fed's hawkish stance and pessimism on Wall Street. Today, it has finally broken out of the consolidation phase, rising in the range of 110.13 and 110.87. US Treasury yields are also growing amid aggressive tightening, so it boosts demand for both government bonds and the greenback. On a Monday, the 10-year Treasury yield climbed above 3.5% for the first time in 11 years. It keeps rising today. The 2-year Treasury yield, which is extremely sensitive to changes in monetary policy, appreciated to 3.99%, almost touching the 2007 high of 4%. The US currency soared to a 20-year high amid such drivers. It was trading in the Asian session at 110.78 versus its main rivals. Of course, its dynamic will be clearer in the US session after the FOMC meeting. Yet there is no doubt that it will maintain its bull run. A robust rally of the US dollar is dragging down its counterparts, especially the yen. Besides, the Japanese currency is weak due to the Bank of Japan's ultra-loose stance. Moreover, the Bank of Japan is not going to abandon its dovish stance, even though almost all major central banks stick to hawkish one. At the same time, the yield gap in government bonds between the Fed and the Bank of Japan is widening. As a result, the yen is heading for a critical level. The Bank of Japan meeting will be held on a Thursday. It's widely expected to keep the parameters of a monetary policy unchanged, so the yen is unlikely to receive any support. The watchdog will hardly intervene to stop its further weakening. There will be no help from other central banks as well. The US prefers a strong dollar to tame galloping inflation. In Japan, the core inflation rose to 2.8% in August. The figure is still significantly lower compared to other leading economies. Over the year, the yen has already depreciated by about 20% versus the US dollar. It has recently touched the critical 24-year low of 144.99. According to analysts, the central bank may intervene only if the yen drifts above the 150 level. However, such a scenario looks unlikely given the fact that the intervention carries many risks and could be ineffective and dangerous. In today's Asian session, the yen reached a high of 144 amid an increase in the greenback. After that, it rose briefly but returned to the price corridor of 143.32 and 144.07. Investors flocked back to safe haven assets after Vladimir Putin announced a partial military mobilization, which comes into force today. Therefore, the dollar-yen pair approached 143.79. It's hardly surprising to see stocks falling given the news from Russia and expectations of a rate hike. Investors in Asian stock markets are unwilling to buy risk assets due to geopolitical tensions between the United States and China over Taiwan. Australian traders are extremely concerned about the state of China's economy, its zero-COVID policy, and the real estate market crisis. As a reminder, China remains Australia's main trading partner. Although Australia is coping well with inflation, the global economic outlook is grim. Moreover, Deputy Governor Michelle Bullock said today that monthly data on the Consumer Price Index is unlikely to have much impact on the Reserve Bank of Australia's October meeting. The Australian dollar, which has a high correlation with Wall Street, dropped following such a vague statement. The Australian and New Zealand dollars reached multi-year lows today amid a robust rally of the greenback and expectations of a rate hike. The Aussie hit a 27-month low of 0.6659 and it's trading today at 0.6669, hovering in the downward channel. Another bearish factor is a falling demand for commodities, and risk appetite is subdued due to the worsening global economic outlook. So the Australian dollar has no positive drivers today. It's moving in the bearish corridor of 0.6655 and 0.6704. The New Zealand dollar also tumbled to its lowest level since April 2020. Kiwi is currently trading at 0.5888. However, in the coming weeks, its price may slip to 0.9500. Today, the NZD USD pair is hovering in the downward range of 0.5876 and 0.5910. There are the main highlights of the Asian session. Today, 2 hours before the close of the American session, the FOMC will announce its key rate decision. The central banks of the UK, Norway, Switzerland and Japan will also hold monetary policy meetings this week. Stay tuned and keep your finger on the pulse, and see you soon.